As Jean-Baptiste Say, a French economist, said, entrepreneurs shift economic resources out of an area of lower into an area of higher productivity and greater yield. Entrepreneurship is really more than just starting companies. It is about driving progress. Today, entrepreneurs play a crucial role in innovation, job creation, and economic resilience. They solve problems, disrupt industries, and create value where others see obstacles. Importantly, as a wave of business owners prepares to retire and the world is facing a succession crisis, entrepreneurs that follow the Entrepreneurship Through Acquisition route are becoming essential to keeping great businesses alive and thriving. Entrepreneurship Through Acquisition, ETA, is a path where individuals, entrepreneurs, acquire and grow an existing business rather than starting one from scratch. Unlike traditional startups, which often struggle with product market fit and therefore face high uncertainty, ETA allows entrepreneurs to take over a company with an established customer base, business model, cash flow, and operations. Let me quote Jean-Baptiste, the French economist, who said that the difficulty lies not in finding a producer, but in finding a consumer. Startups must create both a product and a market. They need to find consumers, facing significant risks along the way. ETA, on the other hand, eliminates much of this uncertainty by allowing entrepreneurs to step into businesses with proven demand. The challenge then shifts from survival to operational excellence, innovation, and growth. This makes ETA a compelling alternative for those who want to lead a business with a foundation already in place. ETA is a very dynamic, evolving field, but today I can say that there are three main ETA approaches. The long-standing one is the self-funded search, management buy-ins. The entrepreneur, the individual, typically finances their own search process, targeting smaller businesses, and retains a significant share of equity ownership after acquisition. For the acquisition itself, the entrepreneur, the individual, can use their personal wealth and/or get money from friends, family, or fools, and sometimes even institutional investors. The second one is a traditional search fund model, which dates back to the 1980s. It was invented at Stanford and Harvard, and it entails investors providing capital to support an entrepreneur's full-time search for a business to acquire and then fund the acquisition, the target itself. The way it works is that often a recent MBA graduate raises around $500K from 10 to 15 investors, and they use the money for 2 years with a mandate to find a company to buy. With that money, they cover their salary and their search expenses. The targets they find, then they propose to their investors who invested in the search. And those investors have the right, but not the obligation, to provide equity and buy the business for the searcher, who post-acquisition becomes a CEO of the business with the ability to get an equity stake. Now, the third one is the modified search fund model, where the entrepreneur, the individual, teams up with a PE fund or an accelerator. These evolving models blend elements of private equity and the search fund model with varying investor involvement in deal structures. But on average, the searcher gets, or the entrepreneur gets, less equity than the traditional search fund model. Either way, each approach has trade-offs in terms of autonomy, financial upside, and access to capital, and individuals decide which model fits best their needs and preferences. Succeeding as an entrepreneur through acquisition requires a unique blend of leadership, adaptability, and a very deep passion for operating and improving businesses, while at the same time being industry agnostic. Unlike startup founders who often are passionate about a product and a service they want to create and focus on ideation and disruption, entrepreneurs through acquisition step into an existing business where success depends on their ability to lead teams, refine operations, and drive sustainable growth. To succeed, like in everything in life, one needs both hard skills and soft skills. And most MBA graduates have the hard skills. The heterogeneity really is in the soft skills. I would say that one of the most critical but rare combination of qualities in an entrepreneur through acquisition is self-confidence and humility. Two traits that are often at odds, as confidence tends to be typically negatively correlated with humility. The best entrepreneurs through acquisition strike this delicate balance. They have the conviction to lead, make tough decisions, and drive growth and change, yet they also possess the humility to listen, to learn, and earn the trust of investors, the business owner that is supposed to sell them the business, the employees, the customers, and other stakeholders. Acquiring a company and becoming the CEO of a company that was founded and led by somebody else means stepping into a culture and legacy built by others. Those who succeed as entrepreneurs through acquisition approach this responsibility with, I would say, deep respect and a genuine willingness to understand before making any changes. They recognize that leadership is not about proving they have all the answers, but it's about engaging with the people who do have those answers and creating an environment where the business can thrive under their leadership. The second quality to succeed, and one that is absolutely important and essential, is passion for operations. Long-standing research and learning theory shows that we learn best when we're passionate about what we do. And this is very critical in ETA, where most entrepreneurs are first-time CEOs stepping into leadership roles with very steep learning curves. Success isn't just about acquiring a business, it is actually about running it effectively and continuously learning and adapting. Now, passion enables learning and operational excellence, and that finally enables long-term success. And passion for being an operator isn't just a nice to have, it is the driving force that fuels the learning necessary to transform a good business into a great one. Beyond that, entrepreneurs through acquisition need resilience to navigate the uncertain search process, acquisition process, running a business, and down the line also selling the business. Search funds and VC both focus on high growth potential, but they differ significantly in terms of risk and returns. One thing we know from finance is that higher risk is associated with higher returns. However, search funds and search fund investments have both lower risk and higher returns compared to VC. Based on the latest data from the search fund study run by Stanford, PitchBook, and Cambridge Associates, search fund investors achieve IRRs, internal rate of returns, between 25 and 35%, while VC investors typically stay around 13 to 15%. More importantly, the risk profile is very different. In search funds, less than 30% of investments have negative returns. So about 20% result in partial loss and only 10% in total loss. In absolute contrast, VC investments see about 90% total loss, meaning nearly all VC-backed startups fail to return capital. Now, this completely challenges the traditional high-risk, high-return logic, but it is what it is. Investors that invest in search funds are exposed to lower downside risk while achieving superior returns. That being said, the search fund landscape is maturing and evolving, and as more capital pours in this seemingly attractive asset class, we see a bimodal distribution of returns, where a smaller group of experienced value-adding investors outperform, while a larger portion of investors fail to meet expected returns. Smart money investors who bring expertise and actively support entrepreneurs in the search, acquisition, operations, and exit phase consistently achieve better outcomes. Ultimately, search funds and ETA provide a compelling alternative, offering entrepreneurs and investors a path to high returns with significantly lower risk.